Hello everyone, welcome back to my channel. I go by One Cheap Compadre and you're watching Cheap Stocks TV, where on my channel we're talking about savings, investing, and even politics. So I just happened to run across this article by CNBC, and let me just read the headlines. It says, just invest in an index fund is useless advice, says financial planner, and how to build your first portfolio. So, I wonder why a financial planner would say that. Because they're losing out on fees. That's why. They don't want you to do something where you can save money and earn money at the same time. Financial advisors want to get a piece of that money. Come on, people. Really? You say this is bad advice? This is the best advice you could ever receive. What, you trying to tell me mutual funds are much better, but all the fees they charge? What, you trying to tell me crypto is better, with all the hacking that they doing right now, taking all the money out of people's accounts? Ask Coinbase. So let's get started. So simply advising someone to check out index funds doesn't say enough to be helpful. Oh, you don't think so? This lead people to the right direction. Why waste people time and give them all this fluff where they can go directly to the source, where they can actually build wealth? Remember, people, the best way to build wealth is through index funds, ETFs, okay? Because you have low expense rates, you have dividends, you can reinvest. It's known as a drip. Why would you not invest in something that has S&P 500 involved, where you don't have to do too much research? You can just buy an ETF that has the S&P 500, that has a list of the top performing companies. Why would you not want to invest in something like that? What, I should go to a financial planner where they're going to tell me probably to invest in mutual funds, probably give me some advice about crypto? Really? Let's continue. So if you're just starting out as an investor, you definitely need to be investing in ETFs and index funds if you're just starting out, or somebody who's been investing. You've probably heard similar advice from everyone from online financial influencers to your dad to likes of Warren Buffett. You mean to tell me Warren Buffett doesn't have any merit? Last time I checked, he was a billion on billion time billionaire who'd been investing since he was 10 years old. That is known as a prodigy. So why would you not listen to somebody who's been doing it since they was 10 years old? Well, you gonna listen to a financial advisor who wanna get you to invest in something where they gonna make some money off of you? Really? Really, people? So just invest in an index fund. Yeah, invest in an index fund. ETFs. Why try to do all that research? The charts do not give you the idea of investing in the future. You can't live off of speculation. You can't go off of speculation. That don't mean anything. Charts don't mean anything, people. Those are just charts. Just because something happened 5 years ago and it went up doesn't mean now or in the near future that it will continue going up. You can't live off speculation alone, and you can't just go off charts alone. Okay, it takes more than that. It takes this, not emotions. It takes the mindset of learning from your mistakes and building off your mistakes to formulate strategies to help you perform better than the S&P. All right? So because these funds, which track the performance of the market index, don't have high price managers at the helm, they come with little to no fees for the investor. You don't say. You mean to tell me investors shouldn't allow themselves to save money? Really? So what? They should look for financial advisors like Madoff, where they can get all their money taken away from them and end up broke? Would that be better for you? right, let's continue. People, I'm telling you, it's really that simple. It's not that difficult. You don't need an advisor to get you to be successful in the stock market. You don't need an advisor. Just read books, people. Read about finance. Read about the stock market. You don't need these advisors. All they do is just take a test, and a lot of them are just trying to sell you something where they can make money off of you, people. That's the bottom line. So, and research has shown that those active managers, on average, may not be worth paying for. You don't say. Most fail to consistently outperform their benchmarks. You telling me something I already know? That's why you just be simple, streamline, just do things the simple way. Why make things so complicated? Why make things where you're losing? Remember, you need to look out for yourself. Don't look out for no financial advisor. They're looking out for themselves. You make your money. So you need to save your money and don't depend on these people. At the end of the day, they're only looking out for themselves. Why are you going to buy into all that where you can do just as good as them? Just read a few books and you can take the test and be a financial advisor yourself. So great. End of the article. Yes, it should have been the end of the article, but we're going to continue since you wrote more. So, right, not so fast, because a certified financial planner, Brad Cloaks, recently pointed out on Twitter, wow, so that means a lot, that broad advice is less than helpful when you actually sit down to build a portfolio. Is it really? Is it really that complicated? Useless advice on social media. You mean to tell me buying index and ETFs are useless advice? Then I would love to hear your advice, because I guarantee index and mutual funds are way much better than the advice you given. I'm pretty sure of that. I bet money on that. Useless advice. What you writing right now is useless. So let's continue. Useless advice on social media, just invest in an index fund, he wrote. Yeah, it's really that simple. It's really that simple, people. Scroll down the roster of available funds on your brokerage website and you'll soon learn that there are hundreds of index mutual funds and ETFs. And your point is, what, you mean you can't cipher through all that and determine what's best for you? Which ones do you buy? How many of them? Well, let me just tell you this. What you should buy is ETFs, index funds that are reasonable, allow you to buy more of that particular company. So it has to be between maybe $10 to $20. Also, the expense ratio needs to be below, I would say, 0.50. Better yet, how about this? Won't you say 0.03%? That's even better. If you can find even lower than that, go for it. Save as much money as you can. Now, the reason why you should buy it as cheap as you can, because that means you can buy more of it. You can own more of it, and that will pay you more of a dividend. Doesn't that make sense? Why would you buy something that you can't afford and only can buy so few of it? Let's continue. So, it doesn't have to be overwhelming in how to put together a portfolio of index funds you can feel good about. Okay. So choosing a core fund broader is better. Choosing a core fund. Let's see what this is about, huh? So use a fund with exposure to a large swath of the U.S. stock market as a foundation of your portfolio. To this end, you wouldn't be wrong to invest in, see? Look what they're trying to get you to buy, people. They upset because they're not making no money. That's why they say this is useless advice. This is the best advice you could ever get. And it's for free from me and anyone else online who tells you to buy index funds and ETFs. They're telling you the right thing to do. Anyone telling you to buy mutual funds, stay away from them. Stay away, people. Save your money. Save your money. So they said invest in mutual funds or ETFs that tracks the performance of the S&P 500. So they first say that ETFs, index funds, is useless, but then see what they try to do? They want to slip that ETF in along with mutual funds so they can cover themselves. But they know that these mutual funds are a waste of time. They're too expensive. These financial advisors are going to make so much money off of you through mutual funds. Stay away from them. Buy ETFs. Buy index funds. Save your money. You are in the business to make money, not make money for these financial advisors, okay? The index contains the 505 largest U.S. stocks and is the one most often used by financial pros and proxies for the broad stock market. I like how they sneak that mutual funds in. I like that. To get a truly diversified core investment, however, it pays to think bigger. Okay, using words like bigger. All right. So says Ben Johnson, Director of Global ETFs Research for Morningstar. Generally speaking, broader is better. He says, in the case of U.S. stocks, I favor a total market index, which will represent about 97% of investable U.S. market cap. You're getting mega cap, large, mid, small, and micro cap companies. Okay. And your point is? The advantage of investing in such an index is a reduction in cost, but not just in terms of fee, Johnson said. You don't say. There are also opportunity costs because the more you narrow a portfolio, the more stocks you leave out. Well, that's the case. Once you build your ETF index funds, then that's where you can venture out into other types of companies. Then that's when you can start investing in crypto or maybe invest in individual stocks. But the foundation is index and ETFs. You save money, you invest money, you get more of a return. Wouldn't you like that better than finding somebody else and they taking your money and you are losing out on the money you could be gaining without that advisor? Yeah, okay, let's continue. There are also opportunity costs because the more you narrow a portfolio, they call that narrowing. You got 500 companies and that's narrow? Really? All right, so a portfolio, the more stocks you leave out, the likelier you are to be missing out on the best performing names. No, that's not true at all. Every performing company and ETFs or index are in the S&P 500. So you're not missing out, people. That is a bold-faced lie. He says, citing the recent addition of Tesla to the S&P 500 as a prime example of missed opportunity for investors in the index. That's not no prime example. I mean, you mean to tell me people haven't been invested in Tesla already? Really? All of a sudden, it's the S&P 500, and now it's something that's new? Okay, anyway. Total stock index funds had owned Tesla since shortly after its IPO. For reference, Tesla went public at $17 per dollar share on the eve of the firm's addition to the S&P. Shares went for $6.95 a piece. Okay. Well, which one you prefer? You prefer $695 a piece, or you prefer a few dollars on the S&P 500, where you can buy fractional for shares, where you don't have to spend so much money? Which one would you prefer? So how to choose among nearly identical funds? You don't need, it's not complicated. You can get all of these name brand companies within the S&P 500. You are not missing out because you're not deciding on going into mutual funds or all these other funds that are not associated with index funds or ETFs. You're not missing out, people. Don't buy into the hype. Conduct the research for total stock market funds and you're likely to get a slew of results. Multiple brokerage firms offer versions of the same basic fund, and luckily for investors, it's hard to go totally wrong if you choose any of them. Man, this is a waste of time, this article. I guess they upset that they're not able to capitalize on investors right now because investors are becoming more savvy and smart to what's going on. And they're trying to get as much money as they can. They're trying to get rid of the middleman and they're becoming their own middleman in their own brand. So what do you guys think? Put your comment down below. Do you think this article actually got you to veer away from ETFs and index funds? Did it actually persuade you to take on mutual funds? Put your comment down below. Do you think this article is a waste of time in your time because it's trying to get you to steer away from things that actually are better for you? So put that comment down below. Share this with family and friends who invest in the stock market and actually trying to learn how to build wealth. Make sure to smash the like button. Become a subscriber. On your way out, hit that notification bell. And remember, there's two types of people. There's smart people and there's wise people. Remember, smart people don't live that long. Wise people do.